This is Chris Maynor coming to you from Union University in Jackson, Tennessee. And in this video, I'd like to go through technical problem number 1 from the first chapter of your textbook. Just a little side note here before we get started that all of the technical problems in your book are answered at the end of the book. And so as we move forward, if you need a little more practice, if you want to work some more problems, there's a good source right there. The answers are there to help you out. Problem number 1 is good for helping us to understand the difference between explicit and implicit costs. We're talking about profits, maximizing profits, measuring profits, and of course profit is revenue minus cost. And in economics, our view of cost is a little different than in accounting. It's a little different than the way most people view cost. And so this will help us to distinguish between explicit and implicit costs. And just as a little review before we get into the problem, explicit costs are those that are associated with using resources owned by people outside the firm. So when we hire workers, when we lease a building, when we borrow money from a bank, we incur an explicit cost. Why? Because we're using someone else's resource. And with all explicit costs, there are actual cash transactions. There are out-of-pocket payments that are made with explicit costs. With implicit costs, there's no out-of-pocket expense. There's no cash transaction because we're using our own resource. The firm is using its own land, its own computer terminal. It's using its own time. And even though the firm is using its own resource, it's not free. There's a sacrifice. Something is given up because most every resource has an alternative use, and that's where implicit costs come into play. So, problem number 1, we have 5 transactions, and for each one, we're going to first of all explain whether it's an explicit or implicit cost, and then second, determine the opportunity cost for each one. And we're given a bit of information here. This is important. We're going to assume that we can invest our money and earn a 10% rate of interest. This will be most important for some of our implicit costs. So keep that in mind as I change slides. Just remember that there is a 10% rate of interest we can earn on our money. So part A, a computer server to run the firm's network is leased for $6,000 per year. So is this an explicit or implicit cost? Well, the way I would do this is I would ask myself the question, who? Who owns this resource? Who owns the computer server? Well, someone else, someone outside the firm, an office supply company maybe, owns this computer server, and we are leasing the server from them. So that tells us that this must be an explicit cost. How do we know that? Well, because this computer server is owned by someone outside the firm. And not only that, we know that there is an out-of-pocket expense. There's a cash transaction in the amount of $6,000 per year. So this is an explicit cost of $6,000 per year. Part B, the owner starts the business using $50,000 of cash from a personal savings account. Keyword there, personal. So who owns the money? The owner does. This is his own personal savings account. And so we know this must be an implicit cost. We're using our own money. We're not borrowing it from someone else. And so that leaves the question of what is the opportunity cost? What's the cost of using our own money? Well, to address that, we ask ourselves, what's the next best use of this $50,000? What could we have done with this money if it weren't used in the business? Well, we know that it could have been put in the bank and it would have earned 10%. So we have $50,000 that could have earned 10%, and that's $5,000 per year that we're giving up, that we are sacrificing by using this money in the business. So this is an implicit cost of $5,000 per year. Part C, a building for the business was purchased for $18 million 3 years ago. It's now worth $30 million. This one's a little tricky. Who owns the business? The firm does. It was purchased 3 years ago. This is the firm's own property. So we know from that we will incur an implicit cost. The question is how much? What is the dollar value? Well, if we don't use the building internally, what's the next best use? What's the second best thing we could do with this business? Well, maybe we could lease it, but we don't really know, given the information here, what the lease payments would be. But we do know the building is worth $30 million. So we could sell that business, sell the building rather, for $30 million, put the money in the bank, earn 10%, which comes to $3 million per year. So by using the building internally, by using the building in our business, we're sacrificing $3 million per year in what we might call foregone interest. So we have an implicit cost of $3 million. Part D, computer programmers cost $30 an hour. Maybe I should have been a computer programmer. The firm will hire 200,000 hours of programmer services this year. Well, again, who owns the computer programmers? Well, this is a resource that comes from outside the firm. This is someone else's time, someone else's labor resource that we're using. So this is an explicit cost. And with explicit cost, there are actual out-of-pocket payments. There's a cash transaction. We have to pay these workers, and we pay them $30 per hour, and there are 200,000 hours. If my math is correct, that comes to $6 million per year. So an explicit cost of $6 million per year. Part E, you'll notice that there's a lot of words here. This is the longest in terms of the verbiage. A firm owns a 1955 garbage incinerator. It's illegal to use, but the firm was grandfathered in. They're the only one that can use it. There's no alternative use. They can't even give it away. Can't even sell it for scrap metal. And so, who owns the resource? Who owns the incinerator? The firm does. The firm owns the incinerator, so we know this is an implicit cost. The question is how much? What's the dollar value of this implicit cost? The answer is zero, because there's no second best use. No one else could use the incinerator. We can't give it away. We can't even scrap it. So a zero value on the incinerator. Very unusual example. So this was question 1, technical problem number 1 from the end of chapter 1. There is one more question I want to just very quickly look at. I usually ask this to my students in my traditional ground-based class, and use this question to ignite a little debate and discussion. Suppose that you and your sister both decide to open copy stores. Your parents always liked your sister better than you, so they purchase and give to her free of charge 3 copiers. You have to rent copiers for $1,500 a month. Does your sister have lower costs in operating her copy store than you have in operating your copy store? And explain. Well, obviously there's a difference here. I mean, obviously, it's better to have the asset given to you than have to pay for it yourself. But from an economic standpoint, you and your sister are the same. In terms of total economic costs, the two of you are the same. Now, sure, you are actually paying out of pocket $1,500 a month for each copier, but your sister has to give up something too. There's no such thing as a free lunch. There's no such thing as a free copier. And when she uses these copiers in her business, she's sacrificing, she's giving up the opportunity to lease those copiers. She could lease them to you and maybe get $1,500 a month. So your cost is explicit, her cost is implicit, but you both have costs associated with the copiers. So from an accounting standpoint, very different. But from an economic standpoint, the two of you are the same. I hope that as we get into the next section on measuring economic profit, this will begin to make a little more sense. But for now, I just wanted us to really focus on the distinction between explicit and implicit costs. I hope these two problems have helped.